Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Market has a lot to focus on this week. Our experts weigh in, namely Jared Levy, Todd Bunton, and Eric Dutram. And there is a lot to talk about this week, so we don't want to waste any time. We've got, just in case people out there watching don't know, earnings to focus on. European Central Bank possible rate cut may be announced this week. Fed meets this week. And jobs report, not to mention all the manufacturing data that comes in. So, any of this have the potential to steal the show this week, Jared?
You know, I think if you put everything together, you have to form. There's no one thing that's sticking out. We saw the miss on GDP on Friday, 0.6% miss by the average estimate. I think in my mind, what I'm seeing here, and we'll talk about this in just a second, I'm sure, is that revenue beats are on the decline, right? 36% or something like that of the companies have beat their very, very low revenue expectations. You couple that with the fact that we're at peak margins and we're seeing some deteriorating macroeconomic data, that's a problem. PMI flash last week we saw. Again, it was a miss there. We've got regular PMI this week. I have a feeling that's going to look bad. Housing, I think, will hold. I think Case-Shiller is going to be the savior this week. Believe it or not, I know it's usually more of a minor number, but I think people are really looking to housing as sort of the savior. But I don't see it, and I am getting concerned in the grand scheme of things as the S&P gets close to its support level. I'm still bullish, but cautiously.
All right, but given all the positive and negative earnings news that's come out so far this earnings season, market's been pretty sanguine overall as far as that earnings news is concerned. Eric, you say it's probably because the news has still been decent?
Well, I think it's been okay. I share some of Jared's concerns about the revenue, but if you look at it on a sector-by-sector basis, it's been kind of hit or miss. We saw Google have a decent quarter, but then IBM was bad. Procter & Gamble was also terrible, but then Coca-Cola did well. So it's hard to get a really good read about any one segment, and I think that's part of the reason why markets haven't been reacting as unfavorably.
And if you look at the overall percentage of earnings beats, it's been a very typical quarter. About 68% of companies have delivered positive earnings surprises. That's pretty average over the last 4 quarters. Of course, revenue is the weak spot, but the market just doesn't seem to care about it.
But isn't that, now to that point, right? If companies are unable to squeeze any more out of their business, if they're unable to to make the plastic any thinner on the products they produce, the next thing they have to do is lay people off, right? I mean, isn't that sort of the next step here? Is that a concern of yours at all? I know for me, probably one of the things I'm worried about is, revenues are declining. The biggest expense for most of these companies are their employees.
Labor. And I agree. I think margins are towards their peak. So earnings growth, I think earnings growth expectations for the market are totally unrealistic for this year and next year. And I think those estimates have to come down. The question is, when do those estimates come down? And more importantly, when does the market care? Because it doesn't seem to care right now.
Yet company guidance has really not reflected that concern just yet.
That's true.
It's still been pretty decent up to this point. So one of the big money questions then, as far as the market is concerned, is are we on the precipice, notice I use that big word every once in a while, of a trend reversal here. And Jared, you say actually that S&P 500 is still in a bullish technical trend, but not far away maybe from failure of that trend.
Yeah, we've actually been in the trend, this current bullish trend, since December of last year. And let's not forget, this is 5 years of a growth cycle we're in, right? And I think almost QE has sort of perpetuated that. But if you look at the technicals, again, the S&P, nothing screaming bullish. It is holding its trend, but 1551, that's a level you're going to look for. If we break below that 1551, hold that for 2 to 3 to 4 days. I'm talking in the S&P. To me, that's a major reversal. And I have a feeling a lot of the bears that have been reluctant will rush in quickly. And remember, summer doldrums, we've got, sort of have a lot of, ducks lining up as a potential sell-off. But again, right now, holding, watch that 1551 level.
So another sell in May?
It's been working for me the past 2 to 3 years. I'm sort of sticking with it, yes.
Eric, you say it's less likely?
Well, I'm looking at some of the pockets that are doing well. I know Jared highlighted housing. I think that's going to be strong. We're seeing very low inventories and pretty solid numbers in both existing, new home sales. So I think that's a good sector to look at. And then also consumer spending. We just saw those numbers come out today, and they beat expectations on most of the figures. So I'm not so sure about the whole market, but I do think there are definitely some pockets of strength that we can look towards.
So on the question of the trend reversal, you're still on the fence.
I think it's hard to say right now. We're going to look to see what happens in Europe with that rate cut, and then some of the jobs numbers that are coming out later in the week. I think that's going to be the real big focus of the market.
Todd, you thought we could be seeing one here.
Yeah, and I thought earnings might be that catalyst. It hasn't been. But like you said, we have a ton of economic data coming out today, or this week rather. Jobs probably being the biggest one. I think that could be the catalyst, or the market could just shrug it off like they have been, weak economic data lately, and we just keep moving higher.
Well, the big Fed focus is the jobs market, and we get a read on that here this week too, with the big jobs report coming out on Friday. Right. So when the Fed gives us a little rundown of their announcement on Wednesday afternoon of this week, are they going to withhold any language change, you think, until they see that report?
I'm sure. I don't think that we're going to see any big movement by the Fed this week. I do believe that the Fed is sort of out of ammunition, right? I mean, we kind of said that before, and you're starting to see again that dissension within the Fed. You know, a lot of Fed presidents backing off of this quantitative easing and saying, hey, you know, we'd like to stop this sooner than later. I just don't know what else they can do. All I believe the Fed has done is they've prolonged the current growth cycle that we're in. I think at this point they've got to let the markets run their course, and that's going to be it. I don't think there's going to be a big change.
They could pull a page from the Bank of Japan's book and buy ETFs and try to boost the stock market.
I mean that would be just nuts. And
I agree.
Yeah, I mean Japan's been in their current situation for like 20 years now. So
decades.
Yeah, they're getting a little more desperate. I don't think we've quite reached that level yet.
I'm worried about reaching stagflation. I'm worried about when all this is over, because we're at the top of that growth cycle, when we start to level out and turn down, I'm worried that these inflationary sort of undertones, that they manifest themselves. They have not yet, but I'm worried they manifest themselves while we're in a period of decline. That's my biggest fear. Again, I'm just a realist. I'm not a perma-bear. Just throwing that out there.
Okay, well, thank you. We appreciate that. Neither one of you two expecting any change in Fed language this week either?
I don't, no.
Okay. Well, this animated bunch still has their stock picks to share with you. That is in our next segment.